Hi guys, good morning and welcome to Trading Hour. I'm Pavitra Parekh. With me are Sumaira as well as Nigel. Guys, a very good morning to both of you. And this is looking like a good looking screen, right?
Sure.
We're back at that 17,700 level for the Nifty. So it's currently around 0.5% higher on the index. And the banks really have it once again today. So take a look at the Nifty Bank Index. That one is up around 0.7%. So some of those larger names will come up for you, whether it's an SBI, IndusInd, Kotak, all of those holding up quite well. Even some of the smaller ones, the likes of RBL, of course, on news flow, but you have something like an IDFC First Bank also, which is seeing good gains. On the downside, it is some of the pharma names which are seeing some cuts. So Lupin, Cipla, Apollo Hospitals are some on your screen. Some of the larger tech names also under pressure. But Nigel, considering the kind of cues we have lined up, it'll be interesting to see how the rest of the session pans out.
Well, that's right, Pavitra. Hi, Sumaira. Just looking at the screen, it's looking pretty good. And remember, the series has been very, very good. If you just see in this series itself, we were up close to 1,000 points at one point of time. We shaved off a little bit, but clearly that 20 DMA, that's the level that, in fact, the bulls got in. And when they got in fact, they made some money from there because it's up close to around 340 points approximately. But the real action, irrespective of what happens on the Nifty, you pull up the advanced decline ratio. That'll give you a better picture. You have close to around 3 stocks that are advancing for just one stock that's declining. So that's pretty good news. And the mid cap and the small cap indices, they're seeing traction out there. Retail portfolios feel good when you have the mid caps and the small caps participating. So let's hope that as well does stay. Hey, Sumaira.
Hi, morning guys. So let's get started. There's a lot of ground to cover. So first up, we start with all that we have lined up for you. Market edges higher on monthly futures expiry day. Realty and PSU banks lead the list of gainers, even as defensives lag. Mid caps are outperforming today. Abhisar Jain, head and fund manager at Monarch AIF, will be joining in to talk about his top sectoral calls as well as his portfolio bets.
Bharti Airtel is in focus as promoter Bharti Telecom is set to buy 3.3% stake worth 12,900 crore rupees from Singtel. More details on that lined up for you in the show.
RBL Bank surges in trade after College Retirement Fund buys shares worth 50 crore rupees in yesterday's session. More details coming up in just a bit.
And the hospitality industry will be in focus. The managements of Charlotte Hotels as well as Royal Orchid will be joining us to discuss demand trends, occupancy levels, and how overall business is panning out.
And we'll also be joined by Aditya Krishna, the chairman and managing director of IT consulting and software firm Saxoft, to talk about the Q1 numbers and business outlook. All of this and much more lined up over the next 60 minutes.
Well, let's focus straight up on the hospitality sector. Sanjay Sethi, the managing director, as well as the CEO of Chalet Hotel, joins in. And Amit Jaiswal, the CFO of Royal Orchid, as well, joins us to discuss demand trends, occupancy levels, and the overall business outlook. Well, good morning, gentlemen. Thanks so much for joining in. We have been trying to book rooms. It's been rather difficult. So I guess it's spelling very, very good times for your businesses. So I'm guessing things are really on the uptrend. But Sanjay, let's come across to you first. Occupancy in the first quarter itself was already around 78% odd. Have you managed to maintain that? What's the occupancy level? And also the revenue per room, if I'm not mistaken, was at around 5,800 rupees odd. Do you see this number trend higher? If yes, where does it go? Go ahead.
So thank you. Good morning, everyone. Pleasure to be on CNBC again. Yes, I think the occupancies are doing extremely well. The quarter one occupancies were on the back of IPL business, which sort of ended on 20th of May. And after that, the occupancies have hovered around the low 70s, 72, 73 mark. And that seems to be the trend that we saw in July. So June and July continued on that trend. And they stay clearly well above pre-pandemic numbers for similar months. Overall, I think the business is trading higher than Q1 and Q2 of FY20. Both rates and occupancies look good. F&B business has grown very aggressively, and we're very excited about what the future holds for us.
Right, but Sanjay, what about the room rates? The average that you gave us was around 5,800 in the first quarter. Occupancy is better than pre-pandemic levels. What was the peak of room rates in the last few years, say in the last 5-8 years or so? And how do you see this moving? Go ahead.
So one correction there, our room rates were not 5,794.
Okay.
Our room rates were actually, average room rates were 7,457.
Okay.
The RevPAR, which is rate per available available room, revenue per available room was 5,794. This was on the back of strong occupancies and rates catching up with pre-pandemic numbers. I think what's really affecting the rates right now is the revenue mix. Most of the revenue is coming from the domestic business travel. Once the international business travel kicks in, the revenue mix will improve to give us higher rates. You asked about what were the rates, historically. Are we at peak rates? Yes, we are not. I mean, 2008, 7 and 8 were the peak rates for the industry. I see that as good news because that shows that there's a headroom for growth and the future growth could be rate driven as against occupancy driven because occupancies are peaking out in most cities for some days a week now.
All right, gentlemen, good morning and thanks for joining us. Let me also bring Mr. Jaiswal into this conversation. So, Mr. Jaiswal, the same question to you. What is occupancy looking like for you right now? And can you take us through what it could be for Q2? Like Mr. Sethi was pointing out, it's definitely picked up across cities. Q2 is also the time when you have a lot of these festivals. So what is occupancy likely to look like for the full quarter?
Yeah, hello. See, occupancies have reached its peak. I can tell you, see, as Nigel rightly said, 78% around occupancy is there. And let me inform you guys that we are maintaining the same run rate even in Q2. And probably in the Q3 and Q4, it can go up by 2-3% more. Okay, because historically the season for our industry is Q3 and Q4. So that is as far as occupancies are concerned. And as far as the ARRs is concerned, yes, let me tell you, we have seen the highest ARR in last decade in the first quarter. And we are very hopeful that in third and fourth quarter, there can be an upward movement of ARR by 10 to 15% further. This is all about our company.
Okay. Mr. Sethi, can you also break up the revenue in terms of, events and rooms, etc., and also, between your hotels and rental properties?
Sure. Sumaira, Q1 numbers, if you look at for the year right now, roughly 62% of the revenue came from the rooms division, and the balance came from a mix of F&B and other revenue. Within F&B, there was banquets, which was about 40%. So 80 crores of revenue came from banquets, from F&B, and roughly around 40% of that, that's 32 crores, came from the banquet division, and largely driven by the MICE interventions that have happened. I would like to highlight here that whilst the room rates haven't grown at the pace that they could potentially have because all our portfolios in big cities and not in the leisure destinations, that's good news actually for us because the headroom for growth remains very robust. So we've had a very good quarter and the rates haven't peaked out as yet is a great story. H2 will clearly be very strong. And I think next year looks like quite a phenomenal year on the rate growth front, with most of the hotel companies targeting RFP rates at 30 to 40% higher than the pre-pandemic rates. Overall, 90% of the business came from hospitality division for us, 10% from the annuity side of the business. And the annuity side is looking very, very strong. I just want to give you a quick snapshot. We have 2,554 rooms now. We have now clear visibility of adding another 1,050 rooms. That's 41% growth on the existing inventory. And this is all going to come in the next 2.5, 3 years. And this is what we have visibility on, firm visibility on. There could be more. On the non-hospitality side, we have roughly around 550,000 square feet on rent, but we have 2.5 million square foot under development. So that could grow up exponentially, adding to stable revenues and very high beta margins to the business.
Okay, all right. Sanjay, let me probe on that point a little bit more. How does the mix change? You have both the segments. You have more number of rooms coming in there, and you have high number of square feet as well to lease out. 88-90% comes in from hospitality. How do you see that mix change going ahead between the rental lease revenue as well as hospitality?
I think short term the annuity business will move from 10% to 25% of the revenue, and EBITDA share could be slightly higher. But in the midterm and long term, hospitality will grow far more aggressively. And therefore, we should be back to roughly around an 80-20 mix in the midterm.
Okay. Mr. Jaiswal, if I can come back to you now. If you could just clarify what is your occupancy right now. I know Chalet said 78. That is for Chalet Hotels. What is the occupancy for you right now?
We are doing around 80% occupancy.
Around 80%. Okay, could you also tell me, in addition to travel, we have been talking about weddings, events, conferences, all of these also coming back in full force. Can you tell us how much of your contribution is from this?
See, as far as Raw Lockheed is concerned, we are focused a lot on our F&B business, and our 33% of the revenue, of the total revenue, comes out of the F&B. And out of this 33%, almost 50% comes out of the banqueting business. That's wedding and all. We have very good destinations which are doing very well as far as F&B is concerned. And we are looking forward to further growth in our F&B business in the last 2 quarters. Because in this quarter 2, the SAYA dates, which we call the wedding dates, are lesser. So in 3 and 4, the wedding dates are quite high. So we are looking forward to our exponential growth in the, the wedding business also.
So how much could the revenue mix get to, for going forward for all of FY23? What do you think the revenue mix could get to for F&B and then the rest of the business?
See, rest of business, in Q1, our mix is 58% comes out of room revenue, 33% comes out of the F&B, and balance is the other sources of income is there. So we are looking forward in the, in going quarters, 35% out of our F&B, 60% out of the rooms, and 5% from the other means of, revenues.
All right, Sanjay, final question then. Growth is good. Both of you gentlemen are sounding very, very optimistic. Me and my co-anchors will have to rethink about our travel plans because both of you are indicating room rates are going to go up. But be that as it may, debt in the books. You were planning on doing some refinancing, I believe. And given that you have such ambitious expansion plans, could you give us a sense about net debt? I believe at last count, it was around 2,200, 2,300 crores odd. But you have some capex as well that's coming on stream. So peak debt levels, what will it look like?
I think the peak debt will happen by end of this financial year at about 2,700 crores. But all of it is going through to growth capital. Now, look, a lot of people think of debt as bad. I think right and balanced amount of leverage is actually great for the business because it allows you to grow. So we are not averse to debt as long as it's sustainable. It allows us to grow at an express pace. And the whatever assets that we build out of this debt are high yielding assets. So if that works for us, there's no reason why we should be conservative about debt. And let me just highlight, it's only India that's averse to debt. Rest of the world actually likes debt.
Okay, all right, very valid points. Ajay, in a business looking up, you're going head on and trying to expand, and it's a good business out there. Final question, Mr. Jaiswal, before we let you go, you have been talking about selling some non-core assets in India, I think in Tasmania as well. Any progress on that front? Now the market has revived. Now you should be able to sell it, right?
Yes, Nigel, as you know, in the 4th quarter of last year, we had sold our Powai land and we had acquired the 50% stake in our Goa hotel, which was, we were holding 50% earlier. Now it is 100%. And that is one very good part of our dealing with the debt asset and investing in the, the money-making asset, and which we have seen in the 1st quarter itself that Goa has done very well. So going forward also, we have another asset in Tanzania, which, our MD, Mr. Balji, is hung on to do some deal there and bring in that money and reduce the debt which is there in the standalone. Although let me tell you guys that we have been able to reduce our interest cost by 2.5% as we got the debt refinanced last year. And so interest cost has come down, although we are looking forward to making the company debt-free. That's our goal, that we should make the company debt-free.
Well, Mr. Sethi, Mr. Jaiswal, it's been good chatting with you all. Thanks so much for joining in. Clearly, both of you are sounding rather optimistic on business, expansion plans, and, room rents are moving up, occupancy levels as well higher. Things looking good for your industry on the whole. For the time being, though, we'll slip into a short break. Up next, we'll get Avisar Jain, Head and Fund Manager at Monarch AIF. He'll be joining in. Remember, they just raised some capital. We'll be wondering, where is he going to allocate that?
अरे भाभी जी बड़े दिन बाद।
मुझे बेस्ट डायमंड ज्वेलरी दिखाओ।
ये एक्सचेंज करा लूं?
बेटा एक्सचेंज में ज्यादा
नहीं, सिर्फ 5% कटेगा।
वाह!
पेश है 95% एक्सचेंज वैल्यू और 90% बाय बैक भी। किसना डायमंड ज्वेलरी?
सर, आपका कार इंश्योरेंस रिन्यू तो सेम कंपनी से करा लो ना।
चिंटू, तेरी पैसे उड़ाने की आदत गई नहीं अब तक?
मम्मा,
PolicyBazaar.com पे 20 से ज्यादा कंपनीज के कार इंश्योरेंस कंपेयर करके खरीदो और पैसे बचाओ। सिंपल।
मैडम जी, वो सारे पैसे लेके भाग गए और मेरा वड़ा पाव भी ले गए।
दिखाते हैं इनको।
मोटे वड़ा पाव। हिलर, निकाल दे इसके बाद।
पंक्चर के बाद भी इससे हवा नहीं निकलेगी, क्योंकि ये है JK पंक्चर गार्ड टायर, जो कील लगने के बाद भी होता है हील। JK Puncture Guard Tire, अब हवा नहीं निकलेगी।
Some folks dream of easy access to airport services. Some have ease of a card. Be it lounge access, meet and assist, spa services, and more. And what powers their credit and debit card is Dream Folks, India's largest airport services aggregator platform. Dream Folks.
ये स्नैक्स एंजॉय करने का नया तरीका है, स्मार्ट तरीका है। पर आपको पता है और क्या स्मार्ट है? इन्वेस्टिंग ऑन एंजल वन, जीरो ब्रोकरेज एंड फुल कन्वीनियंस। अब तो मैं सिर्फ फूड शेयर करता हूँ, ब्रोकरेज नहीं।
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.
Welcome back. Well, we have Abhisar Jain, Head and Fund Manager at Monarch AIF, who joins us to discuss his top picks, portfolio bets as well. Hi, Abhisar. It's been a long while since we chatted. Good having you on the show. You raised closer around 250 crores. AIF, this is the second raise, I believe. So give us some details first. The first fundraise that you all did, I believe, was in October 2020. How has the fund performed, the first phase? And also, in this new fund, which have raised 250 crores odd, how will you deploy it? Only in listed companies? Is that it? It's a long-only fund, I believe. Go ahead.
Thanks a lot, Nigel, for inviting me to the show. And thanks for the compliments on the fundraise. Yes, it's our second fund. We have raised 252 crore. And this is a long-only fund where we will be focusing solely on the listed space. There will be no leverage and no derivatives used. Our first fund was raised of around 70 crores in October 2020. Where we are right now up on an absolute basis around 51-52%. And we are generating an IRR of somewhere around 25 to 26%. We aspire to do the same strategy on the long-only basis with a concentrated portfolio in the second fund. And therein, we have raised 252 crores. I want to mention that the whole raise was completed solely on our own relationships without any distributors and intermediaries. And this helps us keep the cost low for both our investors as well as on the operation side for ourselves.
Okay. So, Abhisar, where is this fresh deployment going now? I mean, since your long-only fund, are you more large cap tilted? I mean, what is the orientation of the fund?
So the orientation of the fund is primarily on the mid and small cap space, which we define as anything below 40,000 crore in the mid cap space and anything below 10,000 crore as the small cap space. However, we do keep the space open for a few select large cap bets, and in that sense, the fund is a flexi cap nature. But the large caps don't exceed at any given point between 25 to 30% and are only in one or two specific sectors per se. So in terms of the the allocation, it will be going in specific sectors that we like in the mid and small cap space, and one or two large cap sectors that we like at current valuation.
And Abhisar, what would those sectors be, both in the large cap space as well as in the mid and small cap category?
Yeah, so see, currently we are liking, several sectors and several sub-pockets, which I will mention. So first is the pharma space, where we like particularly the domestic branded generic space a lot because of its high cash flow nature, high ROE, ROC, and pricing power. We also like the CRO, CDMO space, wherein the global innovators are increasingly outsourcing business to countries like India, where costs are low and the work is good. We also like hospitals in the pharma space. Apart from pharma, we are also liking consumer discretionary low ticket items like, say, electricals, value apparel, and even wires and cables, because we believe that the festive season demand could be good. The wage hikes and the overall economy is doing well. And also we see that there will be some margin tailwinds because the commodities have softened from their recent highs. And these companies can take small price cuts and see the demand bounce back. Other than this, we also like the auto and CV space, wherein there is no disruption from the EV shift. And also we feel that, the CV cycle has still long legs to, go over the next 3 to 4 years. So we like, few companies in the Excel as well as in the Leaf Spring space in the auto and side.
Just trying to derive that Leaf Spring space, I think Jamna Auto is one of those stocks out there. I don't know whether you can talk stocks, but if you can give us a couple of names, that will be helpful. That's point number one. And also, the sector that's caused everyone's fancy in this week itself is the tier 2 banks. Tier 2, I don't know whether you want to call some of them tier 3. But, banking names, would you look at some of these mid-size, smaller size banks, or would you stick to the large names? Go ahead.
Yeah, so Nigel, see, we are very constructive on the BFSI space as such. We have been constructive in our first fund, where BFSI is one of our large weights. We have been preferring more of large caps in that space because the large caps were having fundamentals, to very, very strong set there. On the mid-cap bank side, which you mentioned of the rally recently, I think it's more of a, valuation catch-up, and the street, now feeling quite confident on the credit growth. We have all seen that, the system credit growth has picked up quite well in year-to-date FY23. And that will have a rub-off on the whole space. The credit costs are also expected to remain benign, though jury's out there whether the GNPAs can go up again. Our sense is that it might remain stable, in slight movements up and down, but the credit cost will remain benign. So we continue to like the whole BFSI space. We're still biased towards the large caps out there, rather than the mid-sized banks. But yes, of course, a few select picks can be there. We are not allowed to talk specific stocks, Nigel, because of the AIF regulations, and hence I will, refrain from mentioning any stocks.
All right, Abhisar, final question before we let you go. I recall you used to track the metals and mining space, but now it seems you have moved on. We met a few years ago, I think 5-7 years ago, or at a couple of conferences in your earlier avatar. Any word on that? Would you give it a second look, or you've moved on?
Yeah, Nigel. So of course I've moved on, to the fund manager responsibility, seeing all sectors. But of course, the metal, has always been close to me. So I'll give you a view that, we are right now, a little bit cautious on how China would kind of, act, whether it walks the talk or there will be a lot of production coming out of there. Also, this recent, lot of news around the construction in the residential space in China is keeping this space a little bit, on the tenterhooks, I would believe. And also, I think there will be a lot of capex required for reducing the carbon intensity in all these production. So while the balance sheets have deleveraged because of the good cycle in the last 2 years in metals, but there could be, the capex cycle which may start here. So we are cautious. We like the aluminium space here, which is we are more constructive on. But on the rest of the space in metals, we are a little cautious right now.
All right, Abhisar, we'll leave it at that today. Thank you very much for joining us and taking us through your call on the market. So you definitely like the large cap picks in the BFSI space, some of the consumer discretionary names as well as pharma, but perhaps a little more cautious on the metals. With that, we're going to get into a short break now. When we return, we will discuss the market technicals. Rahul Mohinder will be with us. Are on CNBC TV 18. The market has come off a little bit, so it's currently 17,650 on the index. There you have it on your screen. So we have seen a little bit of a dip in the past 20 minutes or so that we have been speaking. But the Nifty Bank is holding up quite well with gains of around 0.6%. So let's get you a technical check on this market. Rahul Mahinder joins us now. Rahul, good morning and thanks for joining us. So in the past couple of minutes, there has been a little bit of a slip that's come through. It's also the expiry day. So how would you look at it today?
Yes, I think, first of all, we should brace for a bit of volatility on such a day. I think a dip to about 17,580, if it comes there, that's a very good support level. That's a good point to enter with a stop loss, say a good 30, 40 points below that level. So I'm going to watch anywhere between 580 to 600 as the sweet spot of support if I'm just looking at the intraday level. Otherwise, from a medium to long-term perspective, the trajectory continues to remain pretty solid. And I think you can see that, resilience within the heavyweights, whether it's Reliance or the HDFC twins. I think the overall charts speak for themselves. The price action speaks for itself that, there is that sense that the market will continue to move up. Let me come to some stock-specific ideas, keeping this kind of an index view in mind. And again, these ideas may not just be restricted to today's session. I would say these calls would be for over the next few days, maybe a week or two. Reliance, I'm going to start with that because I commented on that. 2660, that's a very important level. The minute we get past this level, we're probably going to head to about 2720. So I'm going to be looking at going long on the stock with a stop loss below 2610. So use any kind of an intraday decline as an opportunity. So keep 2610 as the support level in mind and go long. M&M is another stock I would like to buy. Keep a stop loss at 1245. I think we could be looking at 1310 in the next couple of days. And finally, the other heavyweight I like is SBI. One should enter the stock with a 512 stop loss for targets of about 540. These are a bit of a positional trade. Again, I don't expect any of these to mature right through in one trading session. But on the whole, I think the markets are in fine fettle. Again, intraday, watch that 17,580 mark very carefully. On the upside, if you're trying to look for that positional run, a bit of a bigger run, I know there's a big hurdle at 17,750 to 17,800. I think that's the barrier, the big barrier that I would like to see taken out from a slightly larger perspective.
Okay, Rahul, thanks very much for your calls this afternoon. But let's shift our focus to what's happening globally. Ahead of the Jackson Hole Summit, we're getting a lot of expectations coming in. In fact, Minneapolis Fed President Neil Kashkari says that embedded inflation remains the big fear and a more aggressive rate hike trajectory may be needed to bring it to lower levels. Back, let's talk about what's happening in the telecommunications space. Airtel's promoter entity, Bharti Telecom, is looking to hike stake in the company, with Singtel set to sell over 3% stake to the promoter entity. Nimesh is here with all the details. Nimesh.
Hi, Shamara. So, this is the official disclosure which came from Bharti last late night, wherein it's an indication that Singtel, which owns a little over 13%, in direct entity will sell 3.3% stake at a valuation of close to 2.2 Singapore billion. So that works out to close to 13,000 crores. Now, because both are promoter entities, it looks like it's going to be an off-market transaction between the two promoters. So Singtel will sell 3.3 and the Bharti promoter entity will buy out in Bharti Airtel. That's an arrangement which was officially disclosed. Now, beyond this 3.3%, it doesn't look like there will be further selling from Singtel, at least in the near term. That's number one. And two, there is a disclosure that going forward there could be further readjustments of the stakes between the two promoter entities. So that's the official disclosure. So the market is reacting positively. The stock is because one, the belief is that this will not be in the open market; it will be an off-market transaction. So there will be no supply overhang. And B, the fact that there's not going to be further selling from Singtel, at least in the near term. That's a relief rally. So that's why stock is reacting positively. But in a big corporate development, Singtel has decided to sell or transfer 3.3% stake in Bharti Airtel to the Bharti promoters. And most likely, what I understand from sources, is going to be an off-market transaction.
Okay, all right, Nimesh, valid clarity coming in there. But stay on, the stock of the week really has been RBL Bank. Big fund buying yesterday out of nowhere. That's given 30% returns this week. Tell us more.
That's what, Nigel. So, yesterday everybody was surprised with the kind of move we saw. Intraday, the stock was up 20-odd%. Even today, the stock is up 7-odd%. Now, yesterday post-market, there was a disclosure of on the block deal data that suggested that the college retirement fund did buy 45 lakh shares at an average price of 108, which works out to close to 50 crores of worth of RBL stake that they've bought in yesterday via block deal. Now, I was just looking at this particular fund. It's a large fund globally. It's one of the big funds of the US. And globally, they manage, in terms of asset under management, they manage over $1 trillion. So it's a large fund. And maybe that's why, the stock is reacted positively. Remember, today is the expiry, but the stock is in F&O band. So, bit of covering. Maybe, for the last couple of days, apart from this buying interest, there could be some bit of short covering as well. What has done is this particular deal and the interest of a large fund buying into RBL Bank has led to a bit of a rub-off in the other private bank names, small private bank names as well. So for the last couple of days, most of the stocks are buzzing. But for RBL, there was a disclosure last evening that college retirement fund did buy 45 lakh shares, investing close to 50 crores in RBL Bank.
All right, Nimesh, thanks a lot for joining us and giving us the details on both of these stories on Airtel as well as RBL Bank. But with that, we're going to get into a short break.
Well, the space that's been buzzing around has been IT. And from the IT pack itself, it's been the mid-cap IT stocks. So let's invite a smaller to mid-cap stock, that's Saxoft. That's on our radar, and we're joined by Mr. Aditya Krishna, the chairman and managing director of the company. Hi, Mr. Krishna. Thanks so much for joining in. Well, your sector seems to be having all the buzz. The problem is with regard to attrition. So if you could give us a sense about, what was the attrition number for the past quarter? Do you see that peaking out? And also, if there's attrition that's moving up, then you'll have to give them better hikes, which for the employees is not such a bad thing, but for y'all, it could be a bit of an issue. So quantify that as well. What is the wage hike? Has it already been implemented in the first quarter, or will you all do it in the coming quarters?
We have given a wage hike of approximately 12%. And this was effective April of this year. And it's pretty much at industry standard. Now, is it going to control the attrition? I'm not really sure. But one thing is clear. There is a talent crunch and, everybody's struggling for it. And you would have seen in the media, a lot of the large players making efforts towards managing attrition. And I think that's going to continue. But as far as we are concerned, our attrition last quarter was 25%. It has come off from higher levels in the previous year. We expect it to continue to come down as people come more and more towards office and returning to work.
All right. Good morning, Mr. Krishna, and thanks a lot for joining us. So around 25% attrition is what you saw, and you've implemented wage hikes of around 12%. Can you take us through what the margin is likely to look like now?
We're going to keep margin at 15 to 18%. It is towards the lower end right now, but we are going to keep working on implementing, pricing increases with some of our customers, which, who understand the need for it. And we're pretty confident that 15 to 18 is the range at which we will continue to operate.
All right, Mr. Krishna, the other thing is the currency space, and that's moving around big time. I think you get close to around 50%, 47% odd of your revenues coming in from Americas itself. And the dollar, it's moving like a thug. Is that good for you? If you could give us a sense, because there'll be some cross-currency tailwinds and there'll be some headwinds as well. But for your business, how do you see this currency move impacting you?
We've managed currency reasonably well, I have to say, because we have a large customer in the UK who pays us in euros. So the tailwinds in the US dollar have been offset to a great extent by the headwinds in the euro and to some extent in the pound. We follow a consistent hedging policy. We leave 25% open. We've been doing this for the last 15 odd years. It's held up well for us. It's something that we have to live with. It's not something we can control. What I can control is how fast we grow, how we price our customers, how we manage our attrition. Those are things in my control or in our control, Nigel.
So 25% you're leaving open. So that means that 75% is hedged. Is that the correct interpretation? And also, since you said your core focus is on growth, I know you want to get to a $100 billion odd company, but for this year, what is it likely to be? You're off the blocks in the first quarter, But from year on, what do you end the year with?
This year's looking good, Nigel. It's looking really good. You know, CAGR of 20% plus is something we can definitely realize and maintain. Right now, the space we're in, the spot we're in, the verticals we are focused on, you know, it's all looking positive. Now, I don't have a crystal ball, but so far so good.
But would you have any kind of indication on what the revenue could look like? You did around 150 crores for Q1. For all of FY22, it was around 480 crores. So do you think you could surpass that figure at least comfortably?
Of course, I said CAGR of 20% plus.
Okay.
So of course we will.
Okay.
So you'll be ending closer to around 600 crores then for the year.
That's the target, if not beating that.
And also you have given a target, you know, of being a $100 million company by 2025. I mean, that looks very achievable if you're going to be growing at 20%, isn't it?
Yes, we hopefully will beat that also. So, you know, like I said, we're in a good spot, good space, focused on the right verticals. Everything looks good. But, you know, like I said, no crystal ball, Nigel. Things change so rapidly.
Yeah, but markets, you know, they say dil mange mo. You know, $100 million is what you have put out as a target in 2025. Just going by the numbers that you're talking about, is there a possibility you get to that, say, in FY24 itself?
Definitely possible, Nigel. The way we sit right now, it looks realistic, you know, and I have to say we're very confident at this spot.
With that improvement in revenues, do you see margins moving up? Because 15% is the lower end of the range. Did you expect to move sometime to the higher end of the range?
Margin is really what, you know, is a challenge right now. 15% is the lower end. We're not going to break that. You know, we're going to try moving towards 18, but we're not going to sacrifice growth for it, because you can always catch up on margin. But, you know, if you lose the momentum of growth, it's tough to catch up. So, you know, our focus will be 20-25% CAGR.
Okay, 20-25% CAGR. Mr. Krishna, you also mentioned that, you know, you are looking at inorganic growth as well. Is there any acquisition that you are looking at?
We are looking at, you know, targets, potential targets all the time. We are talking to a number of companies. Nothing's firmed up. As soon as it does, believe me, you know, we'll set out, you know, something in the media for that.
Since we have you on the channel, suppose someone offers you a big check and they say your business is doing so well, Mr. Krishna, will you sell it to us? Then what will you do?
At this point, not contemplating that, Nigel, because like I said, things look really good. You know, never say no is, you know, always the mantra.
Okay, maybe it depends on the size of the check then. It's been good speaking to you, Mr. Krishna. Thanks so much for stopping by and giving us those details. 20% growth is what you're looking at, margins at around 15%, but they'll scale up as things improve. And also, you know, going ahead, in fact, they are looking at growth moving up. Maybe some inorganic growth is something that they're looking at. Well, for the time being, though, we'll slip into a short break. On the other side, you come back, we'll continue. You know, actually, before we go into that break, I think we should get in Ekta. Let's focus on one of the stocks, Lupin, from the pharma space. Ekta joins us to fill us in with more on that. Ekta?
Thanks for that. Well, we've been covering Lupin since yesterday because there is some uncertainty which has now risen over Spiriva Generics. So the company did speak to us earlier this morning and did tell us that, in fact, Spiriva Generic, which is an inhaler drug expected to be one of the big opportunities for them in this fiscal as well as next fiscal, has received a complete response letter from the US drug regulator. Remember that there was a target action date, which means that they were expected to get some communication from the US FDA with regards to Spiriva Generic, and now we do understand, and the company has said that they've got a bunch of queries from the US FDA, which is basically called a complete response letter. The company now, to put it into perspective, how important is Spiriva Generic? It is expected to be one of the bigger launches for the company. Market size is $700 million. It is expected to be a limited competition drug for Lupin. So the street is assuming that once it does get launched, or once they do manage to launch it, you know, if in case the CRL queries are answered successfully, etc., then they can make as much as $100 million per year from this particular drug, assuming there are 3 players in this particular market. Now, the drug launch is also expected to eventually aid the margin performance because it will be a high margin drug. Remember that exit margins guided by the company have been around 18%. They said that it can be pulled up to 20% in case there are launches such as Spiriva Generic. The company has said they are responding to the CRL They cannot talk about the details, whether or not it is minor, major in terms of the queries, but the confidence level remains high at this point in time. When is the approval now expected? It is probably expected to still be launched in Q4. That's what the company is still guiding for. So if in case they do get approval by Q4, they can still launch it in Q4. So it will be added into FY23 numbers as well as in FY24 entirely. Now, the approval is dependent on whether or not they manage to answer those queries successfully. There is now lack of clarity on when they could get approval for this particular drug. Remember, the street was hopeful for August 2022. Now that timeline is pushed down. For some analysts, it was around 20 to 25% of their core earnings estimates in FY23 and as much as 40% for FY24. So that probably takes a bit of a backseat now.
All right, Ekta, thanks a lot for getting us the latest on this. So we'll have to see how things progress on Spiriva generic. And like Ekta pointed out, it is one of the larger launches from the respiratory space. But Ekta, stay on. There was more news that came through on Lupin just a short while ago. They have entered into an exclusive licensing agreement with Japan's IROM group for denosumab. Tell us about that.
Well, yes, there are multiple pieces of news for Lupin besides Spiriva generic, which have been on the positive front since yesterday, but it really hasn't enthused sentiment. So, for example, I'll just start with yesterday. They did announce that they've received approval for an inhaler drug in the US markets, and that should probably add around $10 to $15 million in terms of total sales. They also will be acquiring 2 brands from Boehringer Ingelheim within the diabetes space. They are already selling these 2 diabetes drugs under license from Boehringer Ingelheim in the Indian market. This acquisition is worth 26 million euros. And lastly, now they just released a note just some time ago that they've entered an exclusive licensing agreement with the Japanese company IROM Group. And this is for a biosimilar in their portfolio, which is used for postmenopausal osteoarthritis. And that is going to be a licensing agreement for basically distributing and registering this particular biosimilar in the Japanese markets. So a large amount of news for Lupin. Street isn't enthused. Their eyes are focused on Spiriva generic.
Okay, Ekta, thanks very much for bringing us up to speed. We're going to take a very quick break now, but as we do that, here's a quick reminder for our viewers. It's that time of the year again.
Welcome back. See, what's happened in the last few minutes is, the Nifty saw a bit of a dip, but that intraday dip got bought into. Just take a look at that. And from the broader markets, there are some stocks that are looking rather smart. Aditya Birla Capital spikes up to the high point of the day. Pull up the intraday chart out there. India Mart, another stock that's got absolutely clobbered from the peak. That as well is showing some traction. And PNB as well. It's been a while since that stock. Well, it's up close to around 3.5%. as we speak. Good time though to get in some market opinion. Earlier today, we caught up with Sridhar Shivaram of Enam Holdings, and he says that one needs to buy the dips in the Indian markets, and Indian markets are best placed among the emerging market basket. Let's hear him out.
Our broad view is that the construct for India is looking great. I mean, inflation, we think for the month itself will come around 6, and it is trending lower. GDP growth looks like it's trending upwards. Consumption is looking as if it's coming back. But when we look at the global construct, it just doesn't look that great. I mean, it'll be very difficult for India to move in isolation. So if there is issues globally, we will face the brunt. So I would say that this is more a buy and dips market. You have to be very careful when there is irrational exuberance. Broadly, the value guys are on top, and growth is suffering. But our view in the last 2-3 months is that it's time to slowly get into growth. And the first of the block, at least that's our view, is the financials, which is the banks. See, the private sector banks have really come out very well. The credit costs have actually normalized much faster than anybody would have anticipated. We think that the next 5 years is going to be great for large banks. Any bank which can access liabilities, that's going to be the crux. That if you are able to access CASA and your deposit cost is reasonable, then I think those banks will do well. See, one of the myths with IT services is that when currency depreciates, they do very well. I mean, this is such a big myth. Take the last 6 years, for example. Currency has depreciated roughly about 45-50%, and margins for every companies are down. What we are seeing is from a very low base, we are seeing credit growth come to closer to double digit right now. If this has to sustain substantially, then capex for corporates have to come back. We think that will come back, maybe not as fast as the market is expecting. In the interim, it will be more working capital related and the retail, which will push the loan growth higher. And maybe beginning of the next year, or first quarter, which is the fourth quarter of this year and the first quarter of next year, we'll start seeing signs of capex, because at some point we'll see as demand continues to pick up, the capacity utilization starts to go up.
All right, that is some important market opinion that we're tracking. With that, we're completely out of time on the show. We're inching back towards that 17,700 level, so things are looking up. Thanks a lot for tuning into Trading Hour. Halftime report comes up next.